So thank you everyone for attending today. Just for kind of run a show for this, I'm going to go through a handful of slides with you all, kind of diving deeper on what the Kingscrowd Capital Profitability Fund is all about. Then we're going to bring Teddy on up here from our analyst team, and he's going to kind of dive in on a couple sample type companies that would fit the profile of what we're doing here at Kingscrowd Capital. We'll get into the fund economics, and then we will open it up to questions. But throughout, feel free to drop questions into the Q&A, and we will work to get to as many of them as possible. Just making sure. All right, cool. So for those who don't know me, my name is Chris Lustrino. I'm the founder and CEO of Kingscrowd. I've been at this for over 8 years now. If you add on the blog that eventually became Kingscrowd back in 2018, you're talking about almost 11 years now of doing this. I've kind of dedicated my life and look at myself as doing this for the next 15 to 20 years if I do it right. I love what I do, and I truly feel like we're in the right time, place, and moment to create something really special and really powerful that reinvents the private capital markets to provide better access for investors to access outsized growth opportunities for investing and for founders to find new access to capital in what I think is a fairly to very broken private capital market today amongst traditional private equity and venture capital that I think have a slew of kind of fundamental issues. At the core of what we do at Kingscrowd, though, right, is we track and provide ratings and analytics on pretty much every Reg CF, Reg A, equity, and debt offering in private companies in the United States. That's what we do, right? That's our bread and butter. I think there's now approaching 11,000 offerings to date that have been tracked. Many billions of dollars have been tracked in terms of dollars that have gone into those deals. And what's cool about each and every one of those businesses is that we're getting real data on every one of those businesses. And from those 11,000 companies, we have seen all sorts of unique trend lines and interesting data points that we can learn from. And one of the things that has continuously stood out to me about this market that really, really excited me is that by having real CPA created, right, third party, not created by the founder, but real CPA created financials, audited if they're trying to raise more than $1.2 million, which is more than 80% of the time, or at least reviewed, right, if they're raising up to $1.2 million. These are real financial statements for the past 2 years of those businesses. And because of that, we actually get a true, real look at the underlying fundamentals of that business, good, bad, and otherwise. Sometimes the financials look horrible, and there's plenty of good reasons as to why that's the case. Sometimes the financials look great, and there's other stories that are laid on top of that that make it not so great. Sometimes they're in the middle, and the story could go either way. But what's really powerful is that we can actually do real analysis on these businesses that's not made on kind of like, an art rather than a science. The other thing that I found uniquely interesting about this industry is that traditionally, if you're a founder, basically your only sources of capital are to take out debt through like an SBA loan or something like that, or to have friends and family and a network of people who are down to just fund you, right? If you come from a wealthy family or have access to wealthy people from the university you go to or whatever to kind of get things going, or you're going to have to go the venture capital route. And the only way you're ever going to get to private equity is if you already have millions of dollars in revenue, right? And so the style of companies that are raising in those markets look very kind of binary because if you're trying to raise from venture capital, you have to say you're trying to be a billion or multi-billion. And today I feel like $1 trillion company for them to be at all interested, right? But there are so many companies that are saying, I could grow to be a $50 million exit and I need 3 million to do it. I am a company with $10 million in revenue, $500,000 in profit. I don't want to sell to private equity, but I could use some growth capital to take me to the next level. There's all sorts of stories and investment opportunities out there in the private market landscape that have had no source for capital other than debt capital markets or going the venture route and kind of selling a story that maybe isn't true to who they are. And that's created a real problem in the private capital markets from my perspective. So now in our space, something that's really cool is seeing all these different styles of companies come into our market and try and raise capital for various different reasons, right? For some, it's their angel round. It's how they get off the ground. For others, it's a way to bolster their venture round and engage their community. For others, it becomes a main growth mechanism by which they grow their business. And for other businesses, it's a way to get a little bit of additional growth capital to continue to grow their business over the finish line to an exit in 3 to 5 years. And that to me is a really, really interesting part of the private markets that's been underserved and underinvested in for a very long time is these profitable businesses that are looking for the opportunity to get growth capital, but they don't need a lot. They don't need big institutional dollars. They just need a little bit of growth capital to continue to grow the business. And those can present really attractive investment opportunities for investors with a completely different risk profile from traditional venture capital or even private equity. And that's what we're working on here today. So, kind of getting into a little bit more about what I was hitting on, right, with the problem with traditional venture capital. At the end of the day, there's nothing wrong with venture capital from the sense of if you decide that's the investment strategy you want to take, you should take that investment strategy. And that investment strategy is built on the fundamental idea that I'm going to make 10, 20, or 30 bets. I'm hoping one of these ends up being an Nvidia. And if the rest of them go to zero, I really don't care, right? This is kind of a shot in the dark. I'm hoping one of them has an outrageous return. And the biggest problem I've seen with that model is that you're betting on ideas rather than execution more often than not. And that I think is where a lot of the risk comes into play. And there's a lot of investors and LPs out there that I've talked to over the past 8 years who just aren't comfortable with that model, right? That's not the approach they want to take because while that whole power law, hey, I'm going for the mega win to return my whole portfolio is a very cool concept. More often than not, these venture funds don't hit. They don't hit that power law return. And then you're kind of left with a mediocre return, high fees. And what have you done, right? You've taken on all of that risk and you haven't necessarily received a return that makes sense for all of the risks that you've taken. So with that in mind, there's this idea of could we do something that both attracts a new type of investor and supports a new type of the market that still needs access to capital while providing investors with a completely different risk profile that maybe better fits the way that they want to build their investment portfolio in the alt sector. So from our perspective, right, kind of what I've already started to hit on here is that we can use the equity crowdfunding markets where we're sourcing and seeing over 2,000 deals a year now in an automated fashion, right? Like I don't have to go find these deals out in the wild. They're coming in through the automated data system that Kingscrowd has built. And we're seeing almost 2,000 deals a year. And I expect that to grow to 3, 4, 5, 6, 10, 20, 30,000 companies a year in the years to come. So amongst those, 2,000 companies right now that are coming through the market, guess what? A small percent of them are actually profitable, growing businesses that are throwing off cash right now, right? A lot of them are cash burning, and that's why they're raising money. They're going after aggressive growth or whatever it may be. But some of these are just really healthy, good, quality, profitable businesses that want to raise a little bit of growth capital to continue to grow their business, maybe grow into a new channel or do something that's going to, take a bit of investment up front in order to get the ROI on the back end. And we can find those opportunities, right? If there's 2,000 opportunities out there a year, 50 to 60 of them might fit our criteria, right? I'm not saying there's a million profitable companies that are raising this space every year, but there are a handful. When you have the automated data systems to identify them in the wild with access to every one of those deals to actually invest in, now you have an opportunity to do something really interesting. So what are we looking for at Kingscrowd Capital? What we're looking for in our profitability fund is to invest in businesses when we look at their income statement for the past 2 years have been net income positive, right? Where they have thrown off cash. When all the expenses are taken out of doing their business from their revenues, they still made hundreds of thousands or maybe millions of dollars in actual profit, not adjusted, we work profits, right? From back in the day. This is real profits. On occasions, we might look at EBITDA profitable, but really the focus is going to be net income profitable businesses. We want them to be well rated by the Kingscrowd rating algorithm. I think what we've clearly seen over the years is that companies that are 3.0 or above on the Kingscrowd rating scale, while not perfect, I'm not going to say that, they tend to have really good quality fundamentals where if you looked at every 3.0 and above deal, you'd say like, yeah, I get why it's 3.0. If you look at companies below 3.0, you'd say, oh, yeah, they got some red flags. They have some issues. So we're looking for companies where we think they're fundamentally sound. No company is perfect, but we think they're fundamentally sound. We're looking for at least $1 million in annual revenue. So we want these to be established businesses, right? And a threshold that we've seen is a lot of companies kind of struggle to get to that first million. It could take many years. That's probably one of the longest periods of finding your footing is getting to that first $1 million in revenue. But once you've kind of gotten there, oftentimes you can be 5, 6 years in, and now you're an established business that's figured a few things out and is thinking about how do we scale this business. And we want to see that they're growing year over year, right? So we're not looking for declining businesses. We don't want them to had one good year in their history and now they're declining. We want to see that this is a consistently growing business that's, has good footing, knows what they're doing, and has a path to continue to grow. We want to see that these companies are well valued. So, one of the problems with investing in traditional venture, especially today, as the fund sizes have grown, is that the valuations have been detached from reality, right? In many ways, and the multiples have gotten crazy. I would say for a tech company, if you're trading in the 8 to 15x range, that's fair, right? When you get beyond there, it's like you're really betting on the future. Um, and you have to hope that they have an outrageous, growth trajectory or an amazing, acquirer that comes along and just wants them and will pay anything for it to get them to a really good exit multiple for you, the investor. So what we're looking for at Kingscrowd Capital, a profitability fund, is a 7.5x revenue multiple or lower. So we want to feel as though these companies are well valued, right? They're growing. They have at least $1 million in revenue. They value themselves in the 7.5x or lower rev multiple. They're net income positive. So what this says to me is like this is a really quality, healthy company that has a trajectory to continue to grow and exit at a nice valuation for investors to make money. We want these also to be more established companies because we're hoping that we can shorten the time horizon of what's become the norm in venture capital, right? Which again is okay, especially when you're shooting for that power law and hoping you get that outrageous return. It takes time. Those things do take time. NVIDIA took, 20, 30 years, right, before they hit that $1 trillion mark. But if you're looking for shorter term liquidity horizons, how do we do that? We invest in more established businesses where when we talk to the founder, they say, I'm established. And yes, I am looking for an exit. And that's why I want to boost our growth over the next 2 to 3 years so that I could set up for a nice exit in the next 5. Again, no guarantees with any of these things, right? But that's what we're shooting for is to shorten the time horizon by investing in more established businesses. And lastly, there are worlds where people, I've literally been on calls where they'll say we had a profitable quarter and we didn't even mean for that to happen, right? And they're kind of saying like, how cool, look at us, but they don't really intend to continue to be profitable, which is fine. Maybe they're chasing growth and there's nothing wrong with that in the right context. But what we're looking for here is businesses that are like, hey, we run a fundamentally sound business that throws off cash every year. We want to continue to throw off cash and continue to grow our cash flows. So we're looking for businesses that are profitability focused. That's really, really important to us because we don't want this to become a thing where suddenly there's a downside to it, right? The whole goal here with our fund is we want to find investments where we think those companies can exit in a reasonable timeline in the call it 2 to 7 or 8x return multiple where there's almost no failures, right? These are all projections. And I always want to be careful about that from a legal perspective. We have to say those things, but we're really looking for a low failure rate because the companies are profitable. And if you're profitable, right, then your odds of running off a cliff, unless, the markets really turn or whatever, are dramatically lower than businesses that are burning hundreds of thousands of dollars a month or millions of dollars a year that are really chasing this big dream in the future, but don't have revenues to support that today. So we want businesses that can support themselves without the outside capital. They're just using this outside capital to continue to fuel growth. So we want fundamentally sound businesses that can return nice multiples. We're not looking for the 100x here. We're not looking for the 1000x. We're looking to come out, somewhere around what the median venture return is, which is a 3x in a shorter time horizon with a lower fee structure. And one of the things that I always tell our team is, we've lowered the fees pretty dramatically from a traditional venture fund, right? A traditional venture fund is 2 and 20, and some of them are like 5 and 30. There's some crazy management fees out there. But the reason why we've lowered our fund fees to 1 and 5, and with the AngelList fees, it comes out to about 1.2 to 1.4% management fee and a 5% carry, is because we look at this as a product, not as just a fund, right? This is another way to interact with Kingscrowd ratings. This is a way to automate what we're doing for you, where you could follow the investment strategy on Kingscrowd and do each deal on your own, or you can just invest in this data powered, tech powered investment product that just does all of the work for you. But literally, how do we source these deals, right? We don't need 10 analysts out in the world talking to 10 founders a day to find these deals. We're finding the deals in an automated fashion. Our rating algorithm does 70% of the work and gets us to that last mile where we get to dive deep with those handful of founders a year that actually fit our profile that we potentially want to invest in. And in doing so, we feel like we can create a more cost effective fund. We could create a really unique themed investment product that, from my perspective, if you look out on the market, I don't know anything that exists like this today other than private equity funds that invest in profitable businesses. Except the problem is private equity funds take out a huge mortgage to buy those businesses and then use the profits to pay back that mortgage to buy the business. So even in those cases, oftentimes you're almost break even by the time the private equity fund is running it because they've taken out so much debt on the business. Versus these are passive equity investments in profitable businesses. I've personally never seen anything like it. And it's one of the things that's so excited me about building this fund is that I do think we're creating something that really hasn't been seen on the market before. So I'm really, really excited about where we're headed with this one. I think I hit on a lot of the items here, right, in terms of our portfolio construction. But I want to bring Teddy up here from our team, and he's going to dive on a couple of companies that kind of fit the profile of what we're doing here at Kingscrowd Capital on the profitability fund, and kind of give you a better sense of like what can these businesses look like that Kingscrowd's going to be approaching and looking to invest in as we move forward. So I'm going to turn it over to Teddy. I'm going to stop sharing here and have Teddy come on up. While Teddy comes on up, I do want to drop into the chat a link to AngelList, and this will link you to check out AngelList and be able to actually make your investment if you're interested. We're really excited to start bringing in investors as quickly as we can. My hope and goal right here is to be able to start deploying much sooner rather than later. Hopefully within 4 to 6 weeks we get going, and that's all dependent on us kind of getting those first commitments in the door, so we could start deploying capital sooner rather than later. But we're really excited about where this is headed and excited for Teddy to share a little bit more about kind of the investment strategy by giving you a couple of examples of what this all looks like. Teddy, thanks so much for being here.
Yes. Is my screen showing? All
Yes, it
good?
is.
Outstanding. Well, great. So the first case study we have is Drink LMNT. So Drink LMNT is a hydration company. They produce an electrolyte formula with no sugar, artificial ingredients, and they have kind of a suite of products for high performance athletes as well as kind of the more everyday hydration products for the health conscious customer. Sold in over their products are sold in over 5,000 retail locations nationwide, and they're in major retail chains like Target, Walmart, and Vitamin Shop. So Drink LMT, they launched their first equity crowdfunding campaign in September 2021. At that time, the company had $12.5 million in revenue, growing at 360%, and a profitable net income of 750K. So really the exact type of company we would target with the profitability fund. Now in 2023, just 2 years after this first equity crowdfunding round, the company grew 16 and a half times revenue to 206 million in annual revenue and 41.9 million in net income profitability. So it's really a remarkable trajectory of this company and case study. And we pulled these numbers. These are as of 2023, which is the last annual report that Drink LMNT had to do after their round. So I'm sure these numbers are much higher now, but I think it really just highlights the concept and perhaps misconception that just because a company is profitable and they're not burning hundreds of thousands a month, that doesn't mean that they don't have a well-defined growth strategy. In fact, it can really be a nice self-sustaining flywheel. A company can reinvest profits back into growth without having to take on more external capital. I think Drink LMNT is really just a great case study from equity crowdfunding of a really profitable, strong, sustainable company that was still able to grow at these like venture growth rates really without having to take on a bunch of capital or burning any additional cash. So the second case study we have is Consumer Direct. So Consumer Direct, they offer a suite of fintech tools to help consumers improve their credit scores and get the best terms on loans using some advanced predictive modeling that they have patents on. They have 300,000 active monthly subscribers, 3,800 active distribution partners. And when they raised in 20, so end of 2023, December 2023. They raised at $151 million valuation. And at that time, they had just under 71 million in revenue and 1.1 million in profitable net income. Now, just over a year later, the company raised a new round at $500 million valuation. So 3.3 times valuation increase with $93.2 million in revenue and 2 million, just under $2 million in profitable net income. So Consumer Direct, they're an amazing company because they never raised external outside of equity crowdfunding. They didn't raise any other money from institutional investors, and they basically bootstrapped their way up into basically $100 million revenue business, profitable. With that, yeah, $2 million in profitable net income. And they most recent we heard from the company they're going to be prepping for an IPO, a direct listing at some point, hopefully this year. But I think it's just another great case study for a company that's continuing to grow sustainably, really high revenue marks, and is really kind of fits that exact profile that we'd be looking for in the profitability fund. And I think yeah, it just really shows that, the first case study that was a CPG company. This is a financial technology company. And this next slide kind of shows the recent opportunities. So these are either current or companies raising money today or that raised within the last 6 months. You can see here, we do have another CPG company here, Purity Coffee, Nine Line. They're an apparel company, but Windlift, that's a company using autonomous tethered flight drones to create clean energy. So I really kind of just want to hone in on this that there's not going to be an over diversification into like one industry of like CPG, for example, just because like we do see a lot of profitable CPG companies, but that doesn't always mean they're a great fit for the fund. But we you can see here with Windlift, with Consumer Direct, and with some of the CPG companies, there's a wide variety of companies in the investment universe of equity crowdfunding that we can select from to make sure we don't have over diversification into CPG, for example. And yeah, I think just kind of shows to the increase of quality deal flow that we're seeing in equity crowdfunding. And yeah, so that's sort of the opportunities that we've seen, some of the case studies, and I think just really show that, this is going to be an amazing fun product. We're going to find some great companies to invest into. And as Chris said, I think we're going to be able to projection, of course, but get to that sort of median fund return, but with much lower risk, just given the profile of these companies.
Yeah, and I think, I mean, just looking at it, right, it's like I don't think a lot of people would have realized that in this market you could find a business with $4.2 million in net income or almost 700,000 in net income, right? And these low valuation multiples. Everyone always says how, out of whack or crazy valuations are in this market. I'm like, I wish you spent some time to dive deep. Yes, they are out there, no doubt. That's why you use something like Kingscrowd to identify the good opportunities. Nine Line, right, is raising at a 1.2x revenue multiple, which is fair and in line with what market expectations should be for a business like them. There are very well valued companies that are doing the right things and have really exciting investment opportunities to offer investors. And that's part of what we're all about, right? Is identifying those opportunities. Teddy, if you don't mind, just go to the next slide just to give you guys all a little more detail. And please, as we kind of go over this next slide, if you don't mind starting to drop your questions into the Q&A, we'd be happy to get to as many questions as we can over the next bit regarding the fund. But what does the fund look like overall? So we're targeting a $5 million fund size. Really, I'd say success comes in right around $1 to $2 million, where we'll be happy. This is still a proof of concept to see what does demand look like, right? Especially from our own clients. But for us, this is much more about going through the exercise of building a new, unique investment themed fund product to help you diversify in a more automated fashion, right? From our perspective, the minimum investment is 10K, so we're trying to make this very accessible. And the management fee, as I mentioned, it's a 1% management fee from our side, and then it's a 0.2 to 0.4% additional fee, like all in based on how much we raise. coming from AngelList for all of their admin fees as well. So your fully baked is between 1.2 to 1.4% management fee per year for the life of the fund, and the carry is 5%. So what does carry mean for those who don't understand? If we raise $1 million fund and we return $2 million, just to make the math simple, that would mean we made $1 million, right? On top of the principal invested, we made $1 million. So the gain is 1 million, not 2 million. The gain is 1 million. So then we would take 5% of that $1 million as kind of our additional management fee. It's essentially like the success fee of the fund, which I think comes out to about $50,000 would come out of that. So this is a 10-year term hold. So the goal is that all of the investments return by that time. If not, then shares of whatever is still outstanding would be distributed back to you. We're targeting 25 to 30 companies invested in, all with, the goal of holding them for 5 to 7 years. Again, no guarantees. The investment period is going to be about 4 years. So we're going to look to make about 5 to 6 investments per year for the next 4 years out of the fund. And hopefully in year 5, we start seeing some of those returns coming in as we're finishing up making those last investments out of the fund. Those are the key things. As I mentioned, we're managed by AngelList. I did drop a link to AngelList. We also dropped a link in the resources center to our fund details page that you go and check out. You could schedule more time with Teddy if you want to, if you have very specific questions, but would be more than happy to take any and all questions that folks have here today. And one thing that always gets asked is, can I invest with an IRA? And the very simple answer is yes. It really just comes down to going through the process with AngelList. But once you go to that kind of sign up link for AngelList, then you can enter into the process. They'll ask you all the information to enable that. But I would say over 60% of our dollars come from IRAs. So it is something that is very normal and done all the time. With that, would love to open it up to questions, and thank you all for being here. So first question that came up is there a deadline to invest by? Great question. So I'd say there isn't a specific deadline. My hope is within the next 4 to 6 weeks, we get to a solid close where, call it anywhere between 500 and $1 million is committed, and we kind of have sight lines to what the bulk of the rest will be. That way we could start deploying confidently and have a pretty good sense of what the check size should be in each investment opportunity. So the more you could do this sooner rather than later, it helps us as a fund. I mean, it is definitely a selfish thing to say, but like if you can invest sooner, sure, waiting a little bit, maybe a little better for your returns, waiting another month or two. But from our perspective, it really helps to start seeing what does that demand look like, and allow us to start deploying sooner rather than later. We're already seeing some opportunities we're interested in, and it would be great to be able to do so sooner rather than later. Chris B asks, how much is going to be invested in each company? So it's essentially going to be, pro rata based on how much we raise. Once I have a sense, like I said, I think in the next 6 weeks or so, I'll have a pretty good sense of what size the fund will be. If we're hanging around 500 to $1 million, then I could probably expect based on past experience that we'll end up right around 2 million. If we're closer to 2 million, then I might expect us to be closer to about 3.5 million. Because about a third is raised up front, and then it takes another 2 to 3 months to close the rest. But that would be my expectation is what happens. So we'll base it pretty much on that. So if we raised, $1.5 million, then it would be $1.5 million divided by about 30. And then we'd have a little wiggle room to go up or down based on each investment opportunity, based on how many good deals we're seeing, so on and so forth. But it'd be somewhere right around there. Other questions. One other thing I should mention is, as I'm sure many of you know, we are currently raising for our own business, right? Kingscrowd Inc. So a couple things. First off, people always ask, well, how does Kingscrowd benefit from Kingscrowd Capital? So first off, Kingscrowd Capital LLC, the business unit that kind of holds all of our fund products, is kind of like the GP. We end up accepting all of the fees from Kingscrowd Capital, that 1 in 5% management fee on this fund, that will ultimately funnel up to Kingscrowd Inc. and hit our revenue line. So that's how you benefit as an investor. If we do a good job with our funds and grow our AUM, that will ultimately have a positive effect on growing the value of Kingscrowd by increasing our revenues, right? The second thing that I'll mention is if you invest, and this is on our Start Engine page, if you invest 25,000 in our Start Engine offering, then you get 50% off the minimum investment on the Kingscrowd Capital Fund. So if you don't want to invest 10K, you want to invest 5. If you invest 25 in Kingscrowd, then you actually get half off the minimum investment. And then if you invest 50K or more in Kingscrowd, the business, then you get actually a 50% reduction in the fees of the fund. So instead of being 1 in 5, it would actually be 0.5 and 2.5%. So pretty interesting, especially if you're going to be investing a larger sum. Some folks, invest 250 to 500. It could be pretty impactful there. Great question coming in from Ranjit. Will there be any overlap in investment between this fund versus the other Kingscrowd Outperform fund? Great question. The answer very simply is yes. So we were actually looking at this as we were going through. I don't think it's going to happen often. We're definitely more, looking for those large gain. One of our criteria at Kingscrowd Capital, the Outperform fund, our first offering, is to look for companies where we think they could at least 10x, right? That's what we're looking for. Um, and we're very much more comfortable with like longer term hold periods. We're okay with companies not being profitable. So I don't think it's going to happen a ton of the time. I would put it in the range of like 5 to 10% of the time I could see overlap. I also can see when we're looking at follow-on investments that companies now fit our profile. So for instance, Consumer Direct, right? That's a company we did invest in out of the Kingscrowd Capital Outperform Fund. And like they're doing really well, they're profitable. We think they're going to exit fairly soon. That could be a really good fit actually for the profitability fund. There's another one. I don't know if it hits all of our criteria, but it's fairly close. Helio, we invested in about a year ago. They're doing a new round of funding, profitable, growing. I think they have like 12 plus million in revenue. So that's another one where we might, that might be a fit for the fund as well. And a little further down the road, so on and so forth. So there's going to be instances where that happens. I don't think it'll be a ton. Like I said, probably in that 5 to 10% range overlap, but there probably will be a little bit of that. Great question. Couple. Okay, Paul Pitts. If I put in 10,000, what do you anticipate that becomes, and over what period? So again, I just always want to be really careful. Like these are projections, right? They're forecasts. They're not guaranteed. We're not trying to sell you on anything. Like from a legal perspective, I never want to mislead anyone into thinking something's going to happen because we're living the financial world, we're making investments, and ultimately investments are partly a bet, right? So there's no guarantee, Paul. I want to be very clear about that. You still could technically lose everything. But our goal, as we said, is really to try and shoot for kind of the median venture return, which is basically 3xing the fund, right? Where if we raise 1 million, that becomes 3 million by the end of the fund life cycle. And again, our goal being somewhere in that 5 to 7 years, recognizing that not every investment is going to pan out by then, right? Some are going to take 10 or 12 years still, even if we're shooting for that shorter time horizon. So that's what we're looking to do. That is the forecasted goal. There is no guarantees of that, so on and so forth. But that is what we are trying to accomplish is a 3x in that 5 to 7 year range is the goal. Can we get a written transcript of this saying everything that's in here? Great question. We will have a video recording of this that we will be sharing with all of you that you can re-review. Sorry about that, Chester. And yes, we will be sending out the link to everyone who signed up and everyone who couldn't attend as well. So that's no problem at all. Trying to think of other things. One thing that I think is worth noting, so Teddy, Leia, myself, and Brian Belay, we've been working together on investing out of the first fund for several years now. We're in our fourth year. Right, we've been investing for 3 years, and we're going into our fourth year of investing. We're actually just working on, and we'll have a kind of a nice offering to share in early March. Our progress updates of that fund, how those businesses are going, but we've made nearly 70 investments together, investment decisions together over that period of time. We work really well together. And just so you understand the process, how we work is we essentially look for all of the green light check marks of all the criteria I laid out for you, right? Net income positive for the past 2 years, 7.5x revenue multiple or less, $1 million plus in revenue, growing year over year, right? And all of that comes from our data system. And that's the checklist to go into our, okay, let's analyze these deals. And then Teddy and Leia, they go and do a deep dive, right? They reach out to the founder. They build a deal memo. We have conversations once a week. We sit down for at least an hour and we go through all the deals that they have deal memos on. We ask our questions as a collective. We go back to the founder. We get those questions answered. Then we come back together. We look through those questions and answers, kind of determine our comfort with that. And then we have an anonymous vote where the voting signature is sent out to all four of us, and then we vote anonymously. We explain why we're voting yes or no, but we also vote with a 1 to 5 rating scale of what's our level of conviction for both a yes and a no. Right, 5 being I absolutely want to invest in this. This is the greatest thing ever. One being like, I want to say yes, but part of my gut is still not so sure. Like, this is a really great opportunity. And then on the same side, for no, right? 5, like, please don't invest in this. And one being like, I could say yes, but I'm going to say no this time around. And so itself is also data driven. So we try and make this process as structured and data driven as we possibly can, while also still getting to know the founders and have that qualitative experience with them. And nearly all, not every, but nearly all of the founders we end up backing, I do also have on our podcast Inside Startup Investing. So we really work hard to provide a lot of coverage around these deals. And one other thing that I will mention is if you are not accredited, right, as a reminder, this is only for accredited investors because unfortunately the rules around investing in funds in this country are still really difficult for non-accredited to be able to invest, unfortunately. But if you are not accredited or you don't want to invest 10K or whatever it may be, you can follow our strategy if you're an Edge member on Kingscrowd. And essentially what that means is you go to Kingscrowd, you could sign up for Edge membership. Every time a top deal comes out, that is when we're making an investment out of the fund. And now that we have 2 funds, we'll delineate when that's an investment coming out of the outperform fund and when it's coming out of the profitability fund. So you could kind of by hand follow the same strategy. Um, so anyway, I just wanted to let folks know that if you're interested in being able to follow the strategy, even if you're not accredited. Any other questions?
Yeah, I just want to say I dropped my calendar link in the chat here. If you'd like to schedule some time with me to go over specific questions you have on the fund, feel free to book via that link.
Awesome. Yeah, thanks, Teddy. And yeah, I'm seeing some folks already coming into the fund, which is exciting to see, who are checking it out right now, which is really cool. As I mentioned, we'd absolutely love to have all of you in the fund. And the more you can do sooner rather than later is really powerful for us to be able to hit our goals and start being able to deploy capital. One thing I should note is that you can invest 50% now and 50% in about 2 years when we do a capital call. So essentially, if you're saying, yes, I want to invest 10K, you can invest 5K now and have the option to split into 2 payments. And then the other 5K will ask for you to deploy in about 2 years. There's a button on the AngelList website that I'll quite literally click in about 2 years and say, hey, let's do the capital call. And then they'll basically say, hey, you owe the other 50% and you have to send it in. Usually you'll already have your payment stuff on file, so then it's fairly easy to do. But just when you're thinking about your capital allocation, how much you might want to do, for some folks, that's really helpful to say, oh, great, then I'll do 100K and I'll do 50 now and 50 later. So know that you have that option. Teddy, Leia, myself are always accessible. You could always reach out to us. We do track all of the investments for Kingscrowd Capital in the Kingscrowd Capital portfolio. You will get added to that once you become an investor in the fund. So you can actually track those investments. And we work to provide a quarterly update on the new investments we're making. And we're trying to come up with new ways to provide better ongoing reporting for you to see how the underlying businesses are doing as well. Trying to think if there's anything else. Teddy, any last words you want to share with everyone?
Yeah, I think, this is a really exciting opportunity. I think our first outperform fund was very much a kind of generalist, more kind of a traditional VC area where we're looking for that 10x. We're investing, pre-revenue companies, seed stage, Series A, kind of across the board, and kind of really with that power law type of theory, I think, where it's like, a small percentage of the companies are going to make up for the majority of the returns. I think this fund product is really just very unique in the private market space in that, really focus on profitable companies. And that doesn't mean we're not going to get to the median fund return. It's not like we're our thesis is really that we're going to get to that average median venture return of the 3 to 5, 3 to 6x, but with lower risk. And I think it's really, really, really cool thesis and really excited to continue researching these companies, investing in these companies. And yeah, certainly book a call with me if you'd like to talk about it more, and excited to move forward.
Awesome. Thank you, Teddy. As I mentioned, I've redropped the links into the chat. If you didn't realize, we have an offering open right now to invest in our growth round of funding for Kingscrowd. You go check that out. And if you hit our 25 or 50K thresholds, we'll be sure to send you updated links that fit the criteria that you're allowed to have. And then if you're just deciding you want to invest in the fund, which I'm already seeing some of you taking an interest here, which is awesome, then you can go directly to the link I dropped to AngelList and start going through the process. But please reach out with any questions. Please hit Teddy up. It's an absolute privilege to have all of you on this call today. Thank you so much for your time. We're really excited to be able to do something completely new and innovative for the market. And we hope you join us for the ride. Looking forward to it. Thank you, everyone, for attending today, and have a wonderful day.